Welcome to this stock blitz of Tandem Group. Tandem Group are an AIM-listed manufacturer of bikes, e-bikes, e-scooters, toys and leisure gear. You get a good idea of what they sell from their annual report here. In fact, 58% of their sales come from home and garden stuff and toys like these electronic trucks. And most of their business is business to business, where they make their kid carts and then sell them to these big brands who just stick their label on it. Think of a Barbie scooter. But 25% of their sales are from selling bikes and 70% from e-scooters and e-bikes. And of course, during the Corona period, these were all the craze. I remember every kid wanted a e-scooter from Santa back in 2020, and you could see how lots of people piled into this stock on that craze, and how the share price did very well, going up 3 times over this period. You can see that the e-mobility business segment actually doubled in sales over this time. But as I say, that only represents less than 20% of their overall business. And so actually the sales growth was kind of modest overall. But my starting thoughts are I really do quite like them. They're clean cut, make good products, and are a good way of investing into the e-scooter thing, which I think could continue, although there is some uncertainty over government regulation in this area. But generally, I like their diverse product range, and I like it how they're a fairly clean cut company who manufacture quality products. And they've made a big thing lately of this new warehouse they've built to centralize their operations, which could bring cost benefits. And they've actually bought the land at a bit and are owning the building themselves rather than renting it out. And I like that. That's nice and old school. And so I generally like the business. And then they had this trading update that sales were flat, not that they were dropped, that they were just flat. And then we see the share price plunge back down to roughly. And they then recently reported that their sales were down 35% in 2022, and the share price has been kind of stable ever since. So we do see this nice trend of the income moving away from the expenditure and a nice gap there. This, of course, is before the end of year 22 results, which will then lead to a demolition of their net income as that gap narrows considerably. And you can see on here how their predicted revenue for 2022 places them actually in a worse situation than they were back in 2018 in terms of sales. We see how their income increased from about 33 million up to about 41 million, but we know that that's now dropping by 35%. Their expenditure was fairly controlled, and we see that they've managed to keep their operating expenses fairly stable. So overall, that was how they were able to increase their operating profit quite impressively. Their net income increased from 1.6 million up to about 4 million by 2021. However, sadly, given the results for 2022, we now see them barely making money at 0.6 million. That's according to my amateur estimations. And I based that from their trading update, which was only released a few weeks ago. There we see that their overall revenue is a reduction of 35%, bike sales down 52%, garden tents down 55%, garden furniture and stuff down 55%, and their e-scooters down 46%. When I looked at their half yearly report to try and then work out what their net income would be, we see their revenue dropped 33%, and then the cost of sales also dropped 35%. So that's good. So it means the cost of sales, which is the cost of the raw materials for their goods, and then the cost of shipping them and stuff, that actually does go up and down in line with their number of sales. So that's a good thing for when things get a bit tougher. But we see that their operating expenses, they only reduced by 7%. So this is the problem where their reduction in sales will then create a risk of them losing money. And that's how I got round to this point where they're only going to make 1 million if they're lucky by the end of 2022. And so we really are at a inflection point in terms of their sales, where if this year they're able to achieve sales growth, I think I think they look quite attractive. But if sales continue to decline, we could see them in a situation where they're losing money. So then looking at their assets and thinking about if they were losing money, they have only 3 million in the cash, which is less than before. I'd say they've roughly got enough money churning around at the moment, but reductions in sales, based on what we've seen here, looking at their profit and loss, would mean that they'd be in a situation where they could quite quickly find themselves having to raise debt in order just to keep going as a business. We see that their net assets have increased, have actually doubled since 2018, and that's mainly because they bought this warehouse. They actually bought the land and are building the warehouse themselves. I really like that, but that explains that increase in assets, and it looks to me like they've used this money they were making in the previous years over the Corona boom to then invest in this warehouse, and then they've got a solid asset there. And I really like that. Um, I really like that aspect of them. But some other things to pick out here is the inventories seem a bit high. The inventories, obviously, that's the stock they've made that they've got to shift, and it increasing like this does indicate that their sales are reducing. Also, the trade receivables are lower than they were in 2021. And that's, of course, stuff that they've shifted and they're just waiting the money for. Again, trade payables is low. That could mean that they've got less orders, so they're having to buy less raw materials. So that's a bad sign. Overall, though, don't get me wrong, their balance sheet is fairly healthy at the moment. But like I say, if sales continue to decline in 2023, then they're going to be in a situation where they have to raise debt just to keep going, and it could all start looking a bit ugly. I do my market cap analysis, and like I said before, you can see here how the revenue really has declined to below what it was back in 2018, which doesn't look good. But when you compare against their net assets, their market cap looks like they're very well priced at the moment. Their price to book is only 0.6, so they're currently trading at a 40% discount to NAV. And you see how their net income's withered away, but their price to earnings at 14 is also fairly cheap. Now, my dot plot here doesn't include any manufacturing stocks, so it's hard to compare, but putting them on here, at least against all this other stuff, they do look kind of generally good value. And if I was to spend more time on this stock, I would actually do a load of plots for some other manufacturing stocks to give me my own comparison there. But first off, that looks actually quite cheaply valued. And if you go onto the London Stock Exchange website, you can get these analyst reports. And one of them had price to book, the other one had price to earnings. Neither had both, but for the price to book, we see that indeed these guys agree with my valuation, 0.6, and they are definitely cheaper than their peers, according to this analyst. And this one, I could get the price to earnings, have them at a very cheap valuation against their peers. I think leisure goods here are a better peer to compare than Games Workshop, but leisure goods have a price of earnings of 30 versus 9. So this really does confirm that they are cheaply valued for a manufacturing stock. So I like what they do, and I like the diversity of the different things they sell. And I also really like their niche business model, making electronic carts and other kind of stuff, which is quality gear, where they then sell that to big brands who then stick a label on. I do like that business model, and I do like the angle on miniaturized electric vehicles and scooters, which they are really a play on. I've definitely established that they're cheaply valued as well against their peers and just generally. But ultimately, the problem here is that we're currently in a stagflationary environment in the UK. And for me, knowing that, I just can't bring myself to invest in a manufacturing company at this particular moment. So, yeah, they're a very interesting company, but I just can't spend any more time on them at the moment, given the stagflationary environment. I would like to say thanks to W13 Ken, who suggested this stock. And to summarize, They're a no-go for me. They're a play on e-bikes and scooters, but actually have a good portfolio of other products. They're generally a clean-cut company producing quality products. They have their own warehouse and practically no debt, but they're currently at a pivotal moment and reliant on sales growth in 2023. If their sales decline this year, they could find themselves in a position where they're having to take on debt just to keep going. It's difficult to risk the effect of stagflation and if it's going to happen or not. So ultimately, it's not a sector I'm interested in given the outlook for stagflation in the UK. So I hope you enjoyed that video. Please remember, I'm just an amateur who does these videos for fun. Speak to a professional finance advisor before making any investments yourself. So having said that, have a nice day and good luck with your own investments.
Please read the disclaimer and remember that prices can go down as well as up.